Welcome back to another episode. I'm your host, Tamera. Today, we're going to talk about common issues, lending issues facing buyers today. But first, if you like my content, you're really going to love my escrow team. So let's get a conversation going about your title needs. You can reach out to me on any of my social media platforms. Today's guest is Shaun Schimmelman. He is the Mortgage Mogul. And I brought him in today because we've had a lot of conversations, or at least I've seen a lot of stuff on social media about current issues going on with financing, interest rates, anything and all things lending, right? We've had a lot of changes over the last year, and he's someone that I partner with and wanted to make sure that he came in today to discuss some of these ongoing issues for buyers. So thank you, Shaun, for coming to join me today on another episode of my podcast. Always welcome here.
All right, welcome. Thank you for having me.
Of course. So I'm one of those that just wants to jump right in. Okay, so let's get started with the biggest elephant in the room. Everybody wants to talk about interest rate. I'm so tired of talking about interest rates.
Of course.
So everyone, obviously we've seen interest rates go up lately in the last year. It's been a big change for a lot of people. And so we've had a lot of buyers, potential buyers pulling out of the market. Plus, sellers don't want to sell their house because they're all locked in 2.53% interest rates. So I think the first thing is some really good education about interest rates versus buying power, right? The prices of houses. And we've seen some stability in prices of houses. I mean, it's very pocket, right? Like pocket situations. Certain communities maybe have multiple offers, but for the most part, prices have stabilized. They're not really going up, in some cases going down.
Correct.
And so now we've got interest rates at the highest that we've seen in a long time, which is still not that terrible. So let's talk about interest rates versus, buying a house now with a higher interest rate versus buying a house tomorrow at maybe a higher price with a lower interest rate.
Sure. So, I've been lending for 18 years and rates fluctuate, right? That's part of the market.
You talk to my dad, who's like, my first house was 17%.
Right. And I think a lot of the economy got used to a unrealistic expectation with 2020, 2021 rates where it dropped down to 2-3% interest rates. And that just set a unrealistic expectation for people.
For sure.
But we've had high rates for over about a year, or so. So that's definitely being more of a reality check. So people, I think, are coming more terms with what rates are now. Obviously, they're high. It's the highest they've been in, 16 years, roughly.
What is kind of generally speaking, what is it right now?
7.25% is your conventional national average.
Got it.
Right now. So that, I would say it's high. It's gone up for 0.75% in the last 30 days, right?
Yeah.
And it just continues to fluctuate. Every morning we still look at the bonds, the mortgage-backed securities, and they're going up and down, right? So it's constantly changing. So that's one thing. But with those mortgage rates, yeah, they are higher. But like you said, the home sales market is kind of stabilized, right? So I tell my clients and my agents, I was like, hey, advise them it's a good time to buy. Why? The homes are not inflated in value like they were 2020, 2021. You don't have 20, 30 bids per house. And I had clients at that point who were waiting a year, bidding home after home, trying to get into a house.
Oh yeah, it was terrible. Terrible.
They couldn't even get one, right?
100K over ask.
Oh,
yeah, it was ridiculous.
Right. So homes are more realistic now. They flattened out, right? They're realistic. They haven't really, I wouldn't even say they depreciated in value. They just kind of halted. Right. Some of them, they halted it, they dropped down a little bit because they were inflated at the time of the halt. But I think they've kind of plateaued more. And that's just allowing, a better bang for your buck when buying a house. Right. It's definitely a homestead market for primary residences. It's a tough investor market. Right. Because
no kidding.
Because investors that come to me all the time, they just can't cash flow on a property.
Yeah.
Right. So no matter if it's a good price, they can't cash flow on that property. Right. And with this market, with those rates, I tell people, do you want your cake and eat it too? They're like, what do you mean? I was like, well, you're getting a home at a great price with the easier market to buy in, a lot less competition. That's getting your cake. Right. The rate may not be ideal, but let's face it, who keeps a rate more than 5 to 6 years on average historically? Anyway, everybody refinances, cash out, buys, sells. So get into it with a payment you can afford with rates today for that house at a great price, and we'll turn around and refinance it when rates do drop within the next 2 years. We're going to see a drop. Everybody's predicting that. Fannie, Freddie, HUD, the mortgage-backed securities, everybody's predicting a drop. So then we'll refinance it. So then you get your cake now. And eventually when you refinance it, you're going to eat it too, right? You're going to get the best of both worlds. And you're going to come out ahead in the long run by doing that versus, I want to wait. Common thing is I want to wait till rates drops to buy a house. I'm like, okay, well, what happens then? The home prices go through the roof.
Yep.
There's still low inventory, especially in Dallas. There's still 300,000 people moving to DFW every year. So that's going to be more demand. And then you're going to end up paying it for an inflated value again and fighting for a home of per bidding.
Right.
Right. So I was like, find the home you want, make a move on it. You just date the rate. You don't marry it, right?
I know. I'm thinking that in my head.
That old school saying.
Yeah.
But you're going to get the rate you want when we eventually will refinance it for you. We monitor that as a lender, right? When's the ideal per time for them to refinance?
I know. I text you all the time.
Yep. So I say that. So, along with that, there's a lot of tools we'll go into for products, things we can do to help make that more manageable payment. Such a high interest rate hit. But,
well, before we kind of dive into different loan programs that are offered right now to get buyers into home, let's kind of back up a little bit because that was a lot that you said. There's a little bit to unpack in what you said. So, and you're not wrong. I mean, you and I had this conversation because I called you about my colony rental house that I'm negative cash flowing on, which you can't just look at cash flow. And I know there's a lot of different methods of investing and ways people look at things, right? I was always someone who had to cash flow, right? Until I got into the situation like, well, wait a minute, this is helping with my taxes. So I've seen the other side of it where it isn't always necessarily a bad thing to have some negative cash flow as long as the house is appreciating, right?
Right.
I have not seen that house when I bought it. After I got done with the reno, it was valued at $350. That was last year. December it appraised for $325 when we did the cash out refi. Now my realtor is telling me that I can get $300 for it. But that's not normal. Salina, my neighborhood, did the same thing. It dropped about $75,000. Okay. But my Rowlett house keeps going up in value, right? So that's that pocket stuff that we're talking about. But I think what's really important for buyers and realtors that work with buyers to understand is having that education about interest rates today versus tomorrow, prices today versus tomorrow, because you tapped into it. People are moving here all the time. There's a bunch of pent-up demand because people aren't wanting to buy right now because they're scared of the interest rate. And so next year, if it's next year, we don't have a course. Everybody's saying next year. Right. But if it is next year, that's exactly what's going to happen. All these buyers are going to come out of the woodwork. They're going to start bidding on homes. And now we're going to go back up in values. Right. The smarter play is to buy today and refi tomorrow.
100%. Yep, 100%. Because if we do have a rate and those interest rates drop, the market's flooded back with investors. They've been holding and biting.
I've been waiting.
They've been holding their money for a year now, waiting for rates to drop. And so that's going to flood back in the market, all those investors. You have all these home buyers that have been, and ones moving in, they're just waiting. They're all in hiatus and hover mode waiting. So that inventory of buyers and sellers, buyers, I mean, would be primary investors is growing. Inventory is not. So you think it's tight to buy a house now, wait till the rates do drop, and then you're going to have so many people trying to pounce on a house. And
for traditional buyers, this is sound advice, right? For investors, you have to look at things a little bit differently as well, because you've got to figure in rent comps on top of that, right?
Sure. Yep.
Does the property have the ability to increase? Like, it's one thing to go into a negative cash flow situation temporarily, right? But you don't want to be pouring money into a property that isn't ever going to pay off, right?
Sure.
So housing prices have stabilized. We don't know if that particular area is going to see any kind of appreciation, in the next year or two. Sometimes investors don't hang on properties that long. Then you're walking into a situation where it's not cash flowing. And so you've got to look at the rent comps. And that's why a lot of investors have come out, is because there's just not enough meat on the bone, right? I think I'm waiting for I want the luxury market to come back, please. But I think those are all savvy investors as well. The higher price point houses, those are more wealthy individuals. And a lot of them have pulled back just because their portfolios, that it's not a good idea to purchase a luxury property right now. They're worried about their overall portfolio. So I think the luxury market, when the interest rates drop, we'll start to see that come back, and also buyers will come out. But for investors, if you can figure out how to take at least a temporary hit, because the prices will just keep going up, and you're not going to be able to bridge that gap between the lack of rent and the price of the house, right?
Yeah.
Does that make sense? Did that make
exactly.
sense just now?
Yeah,
Does that make sense? Did that make
exactly.
sense just now?
Yeah, exactly. I mean, some of those properties, they make sense from what you expect to get from appreciation. It may not cash flow immediately, right? And get a little
Yeah.
tight. Like I said, when that market changes too, I mean, a lot of the investors are looking at fix and flip too, because if there's so much demand, they can come in and get something, fix it up, price
Yep.
it up, sell it way over market again. So you'll see a lot of those coming too. Because they can see a quick turn in that house.
I think for investors, the smart play right now is a distressed house because you can pump a little bit of money in it, and then you bought it under value because it's distressed.
Right.
Off market's a great play. Anyway, we can talk about all of that I can talk about that forever. Moving on. Okay. So let's talk about loan programs.
Sure.
Okay. Because the buying power for buyers has been shrinking, right? And anytime the market changes, loan programs, they're not always new. They're brought back, right?
Right, exactly.
And so let's talk about some of the loan programs right now that are helping buyers get into homes.
So, if it's first-time home buyers, we have a lot of different programs. We have different bond programs. We have T-Shack in Texas, which is
what's T-Shack?
T-Shack is a Texas down payment assistance program that's sponsored by the state. And so they'll give you a first-time home buyer anywhere from 3%. And it's not even first-time home buyers, just buying your primary home. So it can be anywhere from 3%, 2%, 3%, 4%, 5% toward down payment assistance. So if you do like an FHA, 3.5% down, you do a 5% T-Shack concession, that's going to cover your down payment, another 1.5% toward closing costs. You could potentially come to the table with nothing.
That's cool.
Right. So that's a great program. There is income limits on those because, different by county.
They're not for everybody.
They're not for everybody. If some people can make
money, pay your own down payment, you don't get assistance.
Exactly. So if you make too much money, they figure you have some in the bank. Right. Yeah. But that's a great program for that. For getting into those, I did a class on USDA homes the other day with an office, just because I think it's a highly underutilized product. Right. So I think that the county limit for Dallas is 380 roughly for a loan amount, but it's not just like rural, like farm country. Like I looked at like Salina and different areas that not necessarily rural, and you could get 100% financing for it with no mortgage insurance.
Okay.
Right. Primary. Yeah. So that's a great tool. And I always tell my realtors, hey, if they're looking to do this type of program, plug the address in, and he'll tell you if you're eligible, you get the green light, you can do 100% financing for it.
Oh, cool.
Right. So it's a great program. So that's another good one that's utilized not enough. You have the standard Fannie Freddie first time home buyers, 3% down versus the 5%.
And to clarify, it's first time to buy a home or you haven't bought one
in like 3 years? I believe 3 years.
Yeah. Okay.
So you can take advantage of that less down. Right. But that's just kind of, those are all options pertaining to people kind of that are tighter on down payment, their first home, different situation like that. A lot of clients maybe just don't fit in the standard box of Fannie Freddie, FHA, and can't get qualified because of maybe income. Right. I have a lot of investors and clients I work with that are self-employed. And
that's always a fun one.
The
1099 employee.
You like to take advantage
realtors,
of. Exactly. 1099. I actually do financing for a lot of realtors because they want to take advantage of the tax laws and write off what they can. And then that limits what their income is for, say, Fannie, Freddie, FHA, because their bottom line is what you go off of. So I have a lot of different non-conforming products, means they're not Fannie, Freddie, FHA. And you can use bank statements, asset depreciation.
Yeah, the bank statement loan has become, that's a new, maybe it's new again, I don't know, but that's been a big
It's been just re-infused with a lot of looser guidelines. I have some products where you can be self-employed under 2 years and you can do a 12-month, 6-month, 3-month bank statement program, things like that. Just kind of whatever's going to show the most income that you're looking for.
Okay. Let's see. Oh, this is going to be a hot topic, or it already is. Student loan payments are going to resume.
Yes.
They took a break because of COVID, and then Biden had that student loan forgiveness idea that didn't ever happen.
Right.
That got rejected. Okay, so when I think there is it October or November. I don't have student loan debt, so I don't know the answer, but I've been kind of watching a little bit. It's later this year,
I believe
when they're going to take back into effect. So, how is that going to affect? Has it has it been, I mean, because you still had the debt, you just didn't have to make a payment, right? So does that have, I mean, I don't know that that would even be
it's not really something that's been that big of a factor historically that from my standpoint, the loans I work with. But yeah, it goes back to the conventional. You count, if you don't have a payment yet, then you use 1% of that for your payment amount. And if you're FHA, you use 0.5%. So you just plug those into their debt. So that's a debt that's added to your debt is what those estimated payments will be if you're not on a payment plan currently. So that just adds to that, which is not substantial.
Okay.
1% to 0.5% for FHA. That's not a substantial thing that swings the needle a whole lot. So it's there, but it would only really affect those right on the cusp of the debt to income approval.
All right. Well, let's skip over that because I wasn't sure if that was really a thing or not. I want to back up on loans.
Yes.
So can I ask you a question? This is for me. Sorry, y'all. I heard something that said all loans are going to become assumable.
Okay, big question. So I get the assumable loan question a lot.
I bet you do as an investor,
right?
Working with investors.
So, assumable loans, Fannie, Freddie. One, if it's non-conforming, they're not doing assumable loans, right? So meaning it's not Fannie, Freddie, FHA, or VA. FHA and VA are approving assumable loans, which means the servicer whoever's servicing that loan goes along with it because those are government-backed programs, right? Government securitized backed programs. So let's just throw out the scenario. Say you're a seller, you owe $300,000 on your house, it's an FHA, and you have a 2.5% interest rate for you got during the COVID period.
Right.
If I want to buy that home from you, you're selling it now for, let's just say $400,000.
Okay.
And you owe $300 on it. Let's make even numbers here. I'm buying for you. That means I can assume your loan if you approve it, and I go through the assumable process. So I assume that $300,000 note at, let's say 2.5%. The difference, what I bought it for, is $100,000. That means I have to come up with $100,000.
Yeah,
down
to give
payment,
you.
right?
Wait. Down payment.
Down payment.
Wait, explain. Back up a second.
So I'm buying, my purchase price is $400K.
Yeah.
My loan is only going to be for what's assumable amount. The balance is left $300,000. There's a $100,000 gap. That's my down payment.
Okay.
Because they can't increase assumable loans. They won't increase the balance. They will take the loan as is, assume it to me, but I have to come up with the difference, right? That's where it is a catch because not everybody has that gap for the down payment.
Why are you calling it down payment as opposed to, because it's just what you owe the seller because the house price is $400,000, right?
Right. Because I'm doing a purchase price of $400,000. $100,000 I have to bring in cash at closing. Yeah. So
to make it
whether it goes to you, I have to bring $100,000 in cash to the closing to cover the difference.
Yes.
So it's ultimately going to you plus closing costs and everything else, right? Okay. But that's how much I have to bring to the table at closing.
Yeah, for sure. Because you got to pay $400,000.
Correct. Yeah. So that's where I've seen. I've heard a few out there. I always see that hiccup because some people wanting to do that may not have the money to put for that difference down. There's another caveat to it. Doing an assumable loan does not take the seller off the hook from that loan liability 100%.
This is where I was wondering about.
That's where if they are still on the hook in case this loan goes into default or foreclosure, you can still be affected as a seller, even though it's assumed, because that's the way that works. It doesn't totally let you off the hook. But if I'm looking at it too, so you have some risk there, but then also if I sold the home for you, it goes for foreclose on you. I'm not off the hook because I assumed it to you. Then maybe I could buy it back cheap and resell it and make the profit.
Okay, right? But most of the time when sellers are doing things like this is because they need to get out of the house, correct, right? So, okay, let's unpack a little bit here. I would have thought, in the investor world, right? Mm-hmm. We've got a lot of this creative financing stuff going on right now. And then and some of it's good and some of it's not so good. But the assumable part, there's people they're assuming loans already, just not going through the mortgage company to do it, right? So if they do that, of course the mortgage company can call the note due if they figure it out,
correct,
right?
Correct.
So there was there were big red flags in trying to get people still doing it, but there's been big red flags to me in that. Now I would have thought that if you had gone through the approval process through the mortgage company, gotten approved to assume the loan, that somehow that would change this liability issue for the seller, but you're telling me no.
So it does change. You're changing the note and the deed over to the new buyer, right? So
Right.
if they're in there, but there is some legal back end. I mean, you can look it up and I can get some more information, articles on. There's some legal back ends that you still are not 100% in the clear as a seller.
Interesting. Does it hit them as debt?
No.
Okay,
No.
so there's just some backroom
Has to do with the deed, right?
Okay.
On the deed, not on the note itself.
Got it.
Right.
Interesting.
But so that's some hesitation there. But either way, that's a small mute point. But what's the hesitation to a lot of people is they don't have the money for the down payment to bring to the table because they're playing the gap, right? And since those times the homes had appreciated some, and so a lot of time.
Well, I work a lot with wholesale investors, and they would be able to bring the money to the table. Yeah,
sure.
It's just that's interesting that there's still some sort of seller liability.
And like I said, that's for like FHA and VA. For conventional loans, they can't mandate it be assumable through Fannie Freddie because those are just they're not backed like FHA and VA. They're securitized through government. They're not backed. So the servicer ultimately has the say so.
Okay.
Of you assuming that loan. But okay, take it in this point. Me as a servicer, I lent somebody my money for 2.5% interest rate. Why would I want to take that loan and give it to somebody else for 2.5% interest rate?
Ideally, you want them to sell it and do a new loan.
I want to pay it off and I can turn around and take that same money and lend it for 7%. Why would I do that? Right. There's that loss of revenue I'd be losing by doing it. Two, there's inherent risk because I mean, you got to go through a process. Is the new buyer just as qualified and as low risk as the one that I'm assuming the loan for, right? So I think that goes into how strong for a servicer looking at it, they have to have incentive, one, to lose that loss of revenue, relending the money, but two, if you have been current the entire process, the seller's been current on it, low risk, high assets, high FICO, and they're going to sell it to somebody else with not as much reserves, lower FICO, more risk of default. Why would I want to take that loan? Because more servicing money on loans is worth based on how it performs.
Okay.
So based on the coupon, what that loan is worth. So if it gets a late payment or default, that value of that loan drops dramatically. Right. So you want to keep it current. So they look at that risk like, okay, well, is this person as strong as this person? Do I want to assume it? If it's vice versa, like the seller has been delinquent on and off and its coupon's worth a lot less, and the new person wants to assume it maybe is a lot more stable. And they think, hey, this is a better buyer because it's going to be on time. It could make the value of that coupon go up by doing that, assuming the loan.
Okay, that's interesting because I was wondering what the benefit would be to why would they approve it? Why would anyone any mortgage servicer approve that?
Which most of them aren't.
Yeah.
Right. They just like, we look at these as a case by case basis is how they say, because they don't have to have a blanket rule. And they're going to look at it in that scenario.
That's an interesting, but I didn't think about the seller being delinquent or not as attractive.
That could be benefit to them versus refinancing at a higher interest rate that could get more benefit by making that loan be a current, right? Because then the coupon's worth more.
Interesting. Okay. What advice do you give to realtors right now to help guide their buyers?
Right now, like I said, just like we talked about in the beginning, it is a good time to buy.
It's always a good
time. So it's a good time to buy, especially in Dallas. Things are going to keep appreciating this. I think it was still going to be from the beginning of the fiscal year to the end. They're still projecting a 6 to 8% increase in values. So that's still a good investment.
It's not as sexy as 2 years ago.
No, but we'll 8% increase is still a better investment than your investments in bonds. Yes. Right. So there's still benefit there. What I tell them is like, hey, I have some great programs that we can use we use the buy down programs because of what it is it's like front loaded discount points. Instead of buying discount points for 30 years on a loan, it's front loaded into the first couple of years of the house. So then you get all that benefit from the interest rate drop and payment perspective while we're waiting to refinance. So you buy the home at a great price. We give you a good rate with a buy down. Okay. You can just negotiate the seller credit to pay that. And we have other options around that. It has to be just third party. It could be from realtor or lender. We can bake in offset some cost to pay some of those points too, but mainly it's paid by the seller. So say, example, $350,000 house, they're giving you a $5,000 seller concession. I can do like maybe a 2-1 buy down, which drops your interest rate 2% the first year. So while 7.25, you're going to pay 5.25 the first year, then 1% the second year, then goes back to the par rate they were approved at. But during that time period, we hope to refinance it.
Yeah.
So then it's like, okay, I'll keep my rate the same the whole time when I refinance, right? That's the plan.
That is the plan.
Right. But either way, it helps them have a lot of saving relief from that high payment those first couple of years.
So do you guys have some sort of trigger that reminds buyers to do when the rates drop? You're like, okay, the rates have dropped. Let's not forget that your interest rate's going to go up.
Yeah, they get alerted through the servicers on those type of loans. When you have the buy down, they get alerted. That
they do?
Yeah, they're mandated. Servicers are mandated to, when you change like an ARMs or anything like that, or like in these buy downs, I think it's within 60 days prior, they have to send out notification, hey, your payment will be adjusting to X because of the next year buy down.
Okay.
Right.
That's cool. I didn't know if anybody, I mean, why would they do that? It doesn't benefit.
They're regulated.
Oh, they're told you now.
They're told
yeah. Well, we learned a lot from
Yes.
the last recession,
Yes.
the Great Recession, didn't we?
And speaking from the servicer side, I've managed servicing for a long time. So I know all the ins and outs of what they have to do with that.
Got it. Any problems with the forbearance stuff we need to talk about?
A little. So mainly pertaining to refinancing that property, right? So if there's a huge amount of people that did forbearances because their servicers were incented by the government to do forbearances.
I know, but it sounded like a
Like the
terrible idea to me at
They
the
basically
time.
say, okay. And I know some servicers were doing, standard 3 months forbearance. And a lot of them were doing 6.
Now, okay, they took those payments when you didn't make those payments for however
Right.
many months. They tacked them on the back end of the loan. No?
Potentially. So the way the process works when you do forbearance, let's just use a 3 month.
I forgot. We talked about
Not a
this.
problem.
It's been a minute.
When you do a 3 month forbearance, so you forbear your payment for 3 months means you don't have to make that payment.
Right.
What happens is it still hits your credit as late payments for 3 months.
Yeah.
Right. But then at the end of those 3 months, you just don't have to make a payment because you're forbearing, meaning I have a hardship. Right?
Yeah.
At the end of those 3 months, they come to you and say, okay, you owe us X amount of dollars for missing 3 payments. Can you pay that? If you can, it brings you current and you continue on with your payments, right? It's because it's considered a short-term forbearance. If you cannot make that payment, then they say a lot of them do an automated mod where they will just take that amount of money you owe, put it on the back of your mortgage and payments, and it start you current with that month and start your payments all over again.
Okay.
And so then you get to just start over. That money goes on the back, right?
Is that stuff still in your credit?
Once you do the mod, and when you do the say you agree to do that modification, whether it be a formal modification or informal, they put it on the back end, you have to make 3 on-time payments of your payment plan. Then they will update your credit that you were on time and reported the whole time because they actually process the modification and deferment.
Okay.
But you have that time period where it's not. You're going to get hit. Your credit's going to get hit with that.
Yeah. Do their payments change?
Not unless you do a formal modification and they can extend. With modification, they have what's called a waterfall. So they'll look at it and be like, okay, well, first thing we'll do, if you can't afford this, that's if you can't afford it, and they'll just put it on the back.
Yeah.
If you can't afford that payment still, then they go through the waterfall for that investor and they'll say, okay, what if we extend it out to a 30 year, if you're on 15, we'll extend it back out to a 30 year, 40 year. Can you afford that payment?
Got it.
Or do we need to drop your interest rate? They'll drop your interest rate and modify the terms to get you within a threshold of debt to income that their servicer or their investor for that loan requires.
Okay.
So they go through that whole list.
Got it.
Right. But that's the process.
Yeah.
Right. But again, then when you're current, you cannot refinance that house until you've been current for 3 months on those payments.
Okay.
Because they want to make sure that you've handled the forbearance issue and you brought yourself current, and then you can look to refinance it after that.
Got it. Okay. I just didn't know if I was wondering if it had an impact now on homeowners. And I know we've got sellers that are selling their houses with forbearance. So I just didn't know what the impact of that
for
was.
a buyer buying a home that's on forbearance, there's no issue because that's the seller's issue.
Right.
If you sell the home before you go through that modification process, your credit won't be fixed.
Got it.
Right. As far as them reporting it current now.
Okay.
So if you did a forbearance, get it current. Otherwise, it's going to be stuck in your credit.
Okay.
Process forbearance, stick to the 3 month payment plan. And then after that, they figure you're good.
Okay.
It's like it's kind of like your probationary period.
Okay.
And then after that, then credit would be updated as current.
Okay. Any last minute advice for buyers or realtors right now?
Like I said, it's just, rates in the market are,
Don't
high.
get stuck on the rate.
Don't get stuck on the rate. Sell the home, plan on refinancing, get paired with a lender, where they can offer them the buy downs, because then it's going to give them that relief from that. And I work with a lot of the sellers that will offer it because it gives more incentives and more buyers shopping for those homes.
Okay.
So get with a lender that does offer the buy downs and something like that. But like I said, focus on selling the house, not the rate, because that's going to be a short-term situation. For a year or two, and a lot of things with they expect them to drop a lot of reasons for next year, but also pre-elections always shake things up. So.
It sure does.
But again, it's a good time to buy. Just know all the tools to do it.
It's a good time to buy. And make sure that you reach out to Shaun to help you with all of your financing needs. So thank you for joining me, Shaun. Always a pleasure to have you on the show. Thank you for being a valued partner of mine. And so that's a wrap. It's another episode. Again, I'm your host, Tamera. If you like my content, you're really going to love my escrow team. So let's get a conversation going about your title needs, and you guys make it a great day.